Welcome to the Multi Commercial Property Acquisition model. This model is suitable for those of you that are faced with multiple propositions or opportunities and you wish to compare them with one another quickly. Or alternatively, if you have a portfolio of commercial properties and you wish to measure them against one another and see how they stack up according to your portfolio averages, etc. Let's go straight to the index. The index will clearly display your input sheet. You only have one input sheet for this model, your dashboard and your aggregate portfolio. You are also able to go to the individual commercial properties themselves, where you'll be faced with valuations and 20-year financial three-statement analysis, etc. So if we start off at the input sheet, we see how simple and coherent the input tables or charts are for each individual commercial property, proposition, or portfolio that you have currently. You'll see we only ask for I think there's 10 or 11 fields. Gross operating income before tax, your op costs and provisions, your estimated cap rate, market related, your percentage escalation on gross operating income, the amount of gearing required or that you currently have, funders percentage, length of loan, company tax rate, cost of owner's loan account. As we know, no loans are free. Estimated capital gains tax provision, depending which state you're operating out of or where the property is situated. Percentage escalation costs and provisions. So once you've inputted these basic fields, you might do it for a couple of properties that you're interested in or interested in assessing. You can then go straight to the property itself. Each commercial property will be faced, or shall I say, as automated results exactly in exactly the same format, so that you're easy to follow. This, for your convenience, is the inputs that you have just brought across so that you can quickly see what you have. We have then calculated your net present value for 20 years, same with internal rate of return and modified internal rate of return. We give you a quick visual graph so you can see what's taking place. And below that you have your 20-year annualized cash flow statements. At any stage of the game, you can see exactly where you are. You'll be able to plan your possible dividend distributions, etc., based on your cash flow statements. This particular investment is cash flow negative for the first 7 years, and then it turns profit in terms of cash flow. Your 20-year annualized income statements, all automated. Everything's automated after your input sheets. You'll see your revenue, your growth in revenue over the years based on your inputs, your expenditures, interest on the external loan as it comes down. Your interest on the loan account stays static because we keep your loan account static. Your income tax has been calculated for you based on the tax rate you've provided in the income statement, and you can clearly see your net profits after tax all the way for 20 years. Then we get to your 20-year balance sheets. We've got your original valuation, a revaluation account, and a capital gains tax account provision. So you will see here in year 2, based on your inputs, your property has grown in value by 1.5 million, and then we based again on your inputs, your capital gains tax provision. We've got a provision account in the event of you exiting the investment. This is very material for you to budget, and we also utilize this in our internal rate of return, net present value calculations, etc., because it is a real expense that you'll be faced if you exit the investment at any stage of the game. So all of our commercial property investments, you can turn this to zero and on the input sheet, but we suggest that you put a realistic capital gains tax figure in here because it is very pertinent and inescapable. Your short-term liabilities, your overdraft has been input. You can see once you become cash flow positive, it becomes an asset in your balance sheet, and everything is coherent, understandable. There are no tricky formulas in this financial model. However, it is powerful when analyzing and comparing investment opportunities with one another. So just as a checkpoint, always make sure that your total equity and liabilities match that of your total assets. And there are no mistakes, but there's very, very few areas where you can make mistakes in this particular model. So you can go and view your CR2, another option that you faced. You can quickly view the internal rates of return, modified internal rates of return, etc. They are all similar. In fact, they're exactly the same other than the inputs you have put in there. The dashboard is nice for you to visually compare. We've got, for example, an internal rate of return comparison of all of them over a 10-year period, so you can quickly see which investments or proposed investments are outperforming and those that are underperforming. Modified internal rate of return, I prefer to use modified internal rate of return because your positive cash flows are invested at a more realistic rate as opposed to the internal rate of return. So you can see exactly those investments that are doing well and those that are underperforming. And then we have your after-tax capital gains tax, after capital gains tax internal rate of return versus modified internal rate of return, all individually over 20 years if you wish to look at them individually again. We then have an aggregate portfolio. This is again just a visual for you to see how they stack up against one another. As you can see, it will automatically calculate the number of opportunities that you have in this portfolio, and the averages. And then over a 10-year period, we measure and compare them against one another, and we give you a ranking system. So you can see these in the red are below average. These are obviously null, so they are below average. And these in the white are above or equal to the average returns of the portfolio. And yeah, we just stack them up for you. We add the internal rate of return and modified internal rate of return. We divide it by 2, and we give you a ranking system so you know how they are performing against one another in each portfolio. So it's extremely coherent. You can move around this model quite easily. You can ignore these and just go straight to the dashboard aggregate value. But it would be great for you to look at each one's cash flow, unique cash flow, the cycles when they become cash flow positive, etc. Other than that, we believe this is the most coherent commercial property either portfolio or measurement of opportunities model that you will get on the market. It has been simplified. There are 10 or 11 inputs, known inputs per commercial property valuation, and you should have no problem operating this or expanding it from 20 to 50 or whatever you may wish. I hope you've enjoyed watching this multi-commercial property acquisition model, and I hope you watch some of our others. Cheers for now.